MPW has just reported its earnings, and what a roller coaster it has been on today. Down 5%, now currently up over 5% on the day. Is now a great time to buy this company that is at the bottom with a very, very high yield, over 17%. Today's episode, we're going to go into detail with their earnings. We're also going to take a look at their income statement, look at their top line revenue reported, as well as their bottom line net income. We're going to have a quick look at the health of the company, total cash versus total debt. We'll see how well they're performing over the last few years versus their competitors. We'll talk about insider buying, insider selling. We'll look at the institutions, if they've been buying these after the earnings have been reported. We'll touch upon the very unsafe dividend safety score, as well as the financial metrics. And we're going to run through the numbers that we have seen from this earnings report this morning. We'll also take a look at that Stewart, which is one of their largest leases. And we're going to look at the numbers behind them. We're also going to see how much they have written off because of this tenant who have been unable to pay for quite some time. And we want to see whether or not they have performed versus the analyst targets. And don't forget, as always, we will run them through the valuation model to get to the intrinsic value as well as our acceptable buy price, given our investor margin of safety. And we'll look towards Wall Street to see what they're forecasting over the next 12 months. So let's start off with their performance. Now, as I mentioned, they are up over 5% today. However, over the last year, they have been hammered down 70%. We can see over the last 10 years, down 71%, even though this doesn't include those dividends reinvested. A very poor performance, with all-time highs at the beginning of January 2022 at $24. They are trading towards their 52-week low with a yield of just under 17% and a P to FFO forward of 2.36, looking incredibly cheap and undervalued. But we do want to discuss some concerns, including a possible dividend cut approaching very soon. Now, first, let's jump into their earnings, which they did report this morning. And what we want to have a look at is how they performed Q4 2023 versus Q4 2022. Now, normalized funds from operations, what we can see, they reported $218 million for Q4 23. Q4 22, they reported a much higher figure, $258 million. So we can see over the last year, the quarter-on-quarter performance, they are down. Now, when we look again versus the 12-month period, so we're looking for the full year 23 versus the full year 22, we see they are down again, recently reporting $951 million, with last year just over 1 million, or 1 billion in fact. So we can see their top line, their normalized funds from operations is down. And when we look at this from a per share basis, 36 cents versus last year's 43 cents, and we can see the same over the full year, 159 versus 182. So on a year-on-year and quarter-on-quarter performance, they have performed very poorly. But what's important is to understand what analysts were expecting and how they performed from that. So as we mentioned, a quarterly funds from operation of 36 cents per share. That actually beat the estimates of 27 cents. So they actually had a beat on the FFO. When we compare this to a year ago, as we mentioned, they are down, however. So whilst they're down from the previous year, they did in fact beat analyst estimates with a surprise, a strong 33%. Now, when we do compare that to how they performed last year as well, we can see even last year they did perform a surprise of 8.57% on the FFO. So that is a nice track record when looking at their funds from operations. Now, when we come and look at their revenue, we see that they posted the top line of negative 122 million for the quarter, which is very, very poor. Now, when we compare that to the previous quarter from a year ago, 380 million positive. So not looking very great, a negative return, which we will touch upon shortly. And we can see this company has not been able to beat the analyst revenue estimates over the last 4 quarters. So not looking too great on the revenue, which we'll discuss. But when we look on an FFO, funds from operation, not only did they beat analyst estimates, but we can see it was a very strong 33% surprise. But again, important to understand, it is still lower from that from the previous year. So Before we jump into Stuart and take a look at those numbers, let's have a quick look at their top line revenue. Now, it's more important to look at their funds from operation for REITs, but what we'll have a very quick look at is to show you that even their top line is looking very strong. 800 million reported in 2018. We're looking for 5 to 10% growth year on year. So 800 million in 2018, 1.6 billion in 2022, and we can see in their trailing 12 months lower than 2022. So over the longer term, it is increasing, but we do see those granular inconsistencies from 2022 to that 2023 number that we did discuss. But again, what's also important to understand is even though their revenue has been increasing over the longer term, do understand that when tenants are unable to pay, then it doesn't really matter what their top line says, because ultimately if they aren't receiving the cash, that revenue figure is essentially irrelevant. Bottom line though, we do see the opposite, going from 1 billion net income in 2018 to 903 million in 2022, and we see that net loss reported in 2023. So again, their bottom line is moving the wrong way, but again, we can catch up on that and discuss in relation to Stuart, which is very important to these numbers. In terms of the health of the company, so this is the quick look at the cash versus total debt. 821 million reported in 2018. 340 million from that latest report. So their cash, they are holding a lower amount than they did 5 years ago. So their cash has reduced. Let's have a quick look at their total debt. Now, it is no surprise, total debt has gone from 4 billion in 2018 to 10.2 billion in their latest report. So whilst their cash has reduced, their total debt has increased. But again, this is understandable for REITs. They do need to issue equity so they can continue to grow and pay off those growth expenditures. Again, we can touch upon that when we look at those metrics, especially that net debt to EBITDA metric. So how have they performed over the market? Now, this is against other competitors, National Health Investors, Physicians Realty Trust, LTC Properties. Well, over the last year, so this includes those dividends reinvested, Medical Properties Trust, the worst performing, and we can see down 66%. Now, we do see with the market, not the greatest returns in this specific REIT sector, but overall, we can see Medical Properties Trust the worst performing. Now, when we extend that to the last 5 years, we also see no surprises there. They are one of the worst performing, down negative 70%. And in actual fact, in this specialized REIT industry, over the last 2 years, only 2 of them have given positive returns. But as I always say, very imperative to understand, past performance is never an indicator of future returns. Very quick look then, we have run MPW through our screener, buys and sells. We can see at least 100 shares. Over the last year, there are no buys or no sells by insiders, so nothing to report, but as always, transparent to run them through this screener. How about the institutional ownership? Well, that sits at 76%, 890 million worth of shares sold over the last 12 months, and we can see a little bit more buying by these institutions over the same period, 1 billion versus just under 900 million. And when we do take a look, the more recent quarter, so Q3 of 2023, we see a lot more selling by these institutions than buying. But as you can see as well, overall, over the last 12 months, a little bit more buying than selling. Also important to understand, with institutions, never copy their trades and always do your own due diligence. So, before we do jump into this dividend safety, take a look at the financial metrics supporting this, we can take a look at the effect that Stuart, their largest tenant, has had on this company. So what's important that I want to draw out is this paragraph, mainly from this information. So for those that don't know, we can see early January Medical Properties Trust worked with Stuart to develop an action plan designed to strengthen Stuart's liquidity as they were facing trouble, restore their balance sheet and optimize essentially MPT's ability to recover, and this is the important part here, unpaid rent, and ultimately reduce MPT's exposure to Stuart. Now, as we can see, they are looking to negotiate a new bridge facility whereby it is expected, and again, an important part, there is no assurance, so remember that, there is no assurance that each party will fund an initial 37.5 million to Stuart based on their achievements of certain milestones previously established in January. And what we can see here, again, another important piece of information, they have already funded 20 million of this, and we can see any subsequent loan fundings would be contingent on Stuart achieving further significant milestones that optimize the amount and timing of recovery. So the main thing I want to take out from this, to say that whilst they are one of their largest tenants, and in fact the largest, it is also important that there is no assurance here that they will be able to pay off that full rent amount to MPT. So again, do bear that in mind. There are some risks when we do take a look at the valuation model at the end to understand and implement this when you're looking at your margin of safety and your investment thesis. Now, in terms of the numbers behind Stuart, this is again what we want to draw out. In terms of the percentage, we can see that essentially MPW reported 122 million loss for Q4. Now, you might question, why is it a negative revenue? It is very weird for a company to report a top line negative. And this is how it's broken down. As we can see, their total revenue from their clients, their leases, 252 million, plus the portion of Stuart, 69 million, which is around 27%. And then we have a small amount here for other cash basis. And then what takes it to the negative is this negative 459 million. So what is this negative 459 million worth, or essentially made up of, that makes their top line negative 122? Well, it's broken down here. We have negative 154. Now, this negative 154 is essentially the write-off of Stuart rent receivable. So they've written off 154 million worth of rent from Stuart. As we can see here, 154. The next line, 224 million, a more write-off of their consolidated straight line rent, 154,224. And we can see also here the 81, so the amount that they have given to them as a loan, as we previously discussed. That portion in terms of the actual interest rate on that loan, so the interest receivable, has also been written off. In total, 459 million. Hence why we see that, yes, they did bring revenue into the company, a Medical Properties Trust, but ultimately they wrote off 459 million worth, which the majority, as we can see on screen, did come from Stuart and their ability to not, in fact, pay the rent. Hence why they reported negative 122 million. So now that we have this information, let's take a look at that dividend safety score. It is coming in at 20, very unsafe. Market cap, 2.15 billion, a mid-cap company. Now, for those that want to know what the recessionary metrics are like, well, they cut the dividend during the last recession. They had above average growth, negative 5%, versus the S&P's negative 12, so above average as we can see. But they did trail the S&P, negative 76%, to the S&P's negative 55. In terms of dividend growth, well, no surprises. Everyone who knows MPW knows that they essentially had a dividend cut of negative 48% last year. Although over the last 5 years and the last 10 years on average, it has increased by 4% on average year on year. So again, given their dividend cut last year, 0 years of consecutive increases. Now, dividend yield theory states a company is undervalued when the current yield sits above the 5-year average. So this would be one sign of undervaluation. But again, dividend yield theory also classes this as speculative given how high it is in comparison. And also important to remember that we never look at any of these models in isolation, and we conclude towards the end. Forward P to FO significantly lower as well than the 5-year average of 14.3. And when we compare it to the sector P to FFO of real estate, it is 13.5, much higher. So let's take a look at the payout ratio. Now, typically on the channel, free cash flow payout. However, for REITs, a lot more volatile. We focus on the adjusted FFO, adjusted funds from operation. For medical building REITs, we want to see below 95%. It's only been above that in 2019, so arguably based on this information, 2013 at 76%, 2024 at 64%, no issues there, but so far we've only looked at part of the data. Adjusted funds from operation per share, you want to see this consistently going up for REITs. We can see it has gone up, although very inconsistently. 2023 and 2024 were lower, so again, bear that in mind. Their adjusted funds from operation, that growth, as we can see from below in percentages, negative 6% 2023, expected negative 30% in 2024, isn't looking too great. So again, bear that in mind when we conclude and look at our margin of safety. Sales growth, double digits nearly every single year. Remember, steady moderate growth for REITs, 5 to 10%. Although we note 2022, only 1%, 2023, negative 12%. And remember, it is important, just because a REIT is increasing their revenue, their top line, if they're not banking that cash from their tenants, in reality, it means nothing. Shares outstanding, very typical for REITs, as we mentioned early on other episodes, to issue shares, so diluting your position over the longer term. Some REITs issue and dilute your position at a much faster rate, like Realty Income, like we have recently reviewed on the channel. And we can see the reason for this is to essentially fund property acquisitions, as they do retain little of those internally generated cash flow after paying dividends. Numerically, though, we can see their top line 250 million to 1.42 billion. ROIC, now for REITs, typically what I like to see, 3 to 5%, for other companies 10% or more. The reason for this, it gives me faith that management are able to effectively allocate their capital. Up to 2022, looking pretty strong, 4 to 7%. 2023, it has dropped down to 3%. Now, it is within that catchment that I like, 3 to 5%. But it is a big drop, so just purely looking at this is something I would consider to review quarter on quarter, year on year. Talking about ROIC, I did do a recent newsletter running through my 7 golden dividend metrics and other topics. If you want to grab a copy, completely free. We run through lots of different things, looking at undervalued companies with strong upsides. We run through companies where they have done a lot of insider buying and insider selling, and our more recent article looking at companies that aggressively buy back shares. Completely free. If you do want to grab a copy and get these weekly newsletters, click on the pinned comment below. So now we take a look at the operating margin. Not looking too bad from 2013 to 2022, but it has decreased in 2023 to 40%. So do bear that in mind. It has strayed away from their averages over the last 10 years. Now, one of the most important metrics, especially for REITs, the net debt to EBITDA, earnings before interest, tax, depreciation, amortization. And one of the strongest reasons why I do see another dividend cut incoming. What this essentially shows us is 1, the dividend safety, and 2, the balance sheet strength. These are the number of years it would take the company to pay off all of their debt net of cash on hand. For REITs, normally around 5. For medical building REITs, we can extend that to 6. Look, over the last 10 years, they've pretty much been above that. 2022, 7.54. 2023, 8.33. 2024 expected to go even higher. If I had to be a betting man, which I'm not, I would say the dividend cut is coming very, very soon, given that they are just taking on too much debt. And it does look, with this Stewart issue and how much they have written off just in this quarter, cash could be a big issue for MPW. So let's jump into the valuation. As always, if you enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So the first model we're taking a look at today is the REITs multiple valuation model, companies in a similar sector and size that we analyze. We have their P to AFFO multiple as well as that of MPW, and we can see based on the intrinsic value some severe undervaluation, but as always do bear in mind we're not looking at any of these models in isolation, and we will conclude towards the end. We then have the DDM dividend discount model with the growth rate over the last few years. Now average negative 7% over the last 5 years. Honestly, moving forwards, I'm expecting a small dividend cut, or at a best just to keep it flat. So we've gone for 0%, and we can see the intrinsic value here shows another sign of undervaluation. We then move on to the DCF model with the free cash flow year on year. The average growth rate very high. Forward looking, I've gone extremely conservative. Then we get the present value of these future free cash flows and terminal value based on our discount rate. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we have another sign of undervaluation. So the intrinsic value is just the average of these models, and in today's episode we are going to solely focus on the DCF model and the dividend discount model. Given the multiples valuation, those other companies that we looked at aren't in a similar situation from what we believe to MPW. So the intrinsic value is coming to $6.86. And as always, if you want to grab a copy of the valuation model to get to the intrinsic value, as well as the acceptable buy price of companies in your own portfolio, then do click on that pinned comment below where you can grab a copy. Margin of safety, now this is very important. Typically, we start off with 10% if it meets 3 criteria. Wide moat, strong financial metrics, good forward-looking data, which we don't believe MPW has. And you keep going until essentially you get near the current trading value, and we can see that MPW does have a very, very large margin of safety. At 50%, it isn't quite there yet. At 45%, around 5 cents or 6 cents shy. So we say MPW, Medical Properties Trust, has around 45% margin of safety. For a lot of people, including myself, this is still not enough for such a company with the worries that they have long term. We can see the issues with Stewart. We can see that dividend cut does look like it needs to be necessary for this company to continue its operations in the longer term. But as always, there are also benefits with this company. A lot of people will look at this and say it is trading at a very, very low forward P to AFFO. But again, let us know your thoughts in the comments below. This does divide the dividend community. And when we look towards Wall Street over the next 12 months, well, they expect a price target of $4.86. So they themselves see upside of 27%. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And also let me know your thoughts, whether or not you are happy with the MPW earnings and you have gained on that morning up 5%. As always, have a great day. See you on the next one. And for now, take care.